So let's look at this first exercise, but before we really get into talking about this exercise, we've got to remember there are two different types of pension plans. There's a defined contribution plan and there's a defined benefit plan. Now, a defined contribution plan is basically like your 401ks. This is where you pay into it, your employer matches you. The employer is not responsible then for the actual results. The employer doesn't have to make the payout later. Wherever the fund is and your elected choices will determine how much your payout is in the future. Now, a defined benefit plan is a little bit different. In a defined benefit plan, the employer is actually responsible for making those payments. So when we go over this accounting, we're talking about that defined benefit plan, because this is where the employer is responsible to pay out the obligation. Now, when we're talking about a defined benefit plan, there's really three things we have to understand. One is the projected benefit obligation. That's the amount that we are expected to have to pay out in future pension claims. In other words, the amount of retirement funds we will eventually have to pay out to our employees. That's called the projected benefit obligation, or the PBO is how I refer to it a lot of times. The next thing is the pension expense. That's the actual annual expense of having the pension plan, and that will go on our income statement. And then finally is the plan assets. The plan assets is the amount that we have available to us to cover the projected benefit obligation, or the PBO. We usually show those net with the PBO on our balance sheet. If our plan assets are greater than our PBO, then we show an asset on our balance sheet. The reverse is true. If our PBO is greater than our plan assets, we actually end up in a liability situation. So those are the three things we have to understand. And in order to do a full pension problem, let's take each of those pieces and look at how do we calculate the PBO, how do we calculate the pension expense, and how do we calculate the plan assets. So that's where we're going to start. Now, I highly recommend that when you do any of these problems, you have our neat little sheet that we talked about in the first video. Notice you have several components here, and each of these make up our PBO, our plan assets, and our pension expense. So let's look at this first problem and see how we can use our sort of worksheet here to come up with our revenues, expenses, assets and liabilities as well in that. All right, so on January 1st of year one, Stanley Corporation's projected benefit obligation was $25 million. Let's stop there. So here is our beginning balances. Now notice we're only going to have a beginning balance and an obligation and asset. Pension expense, you will not have a beginning balance in because expenses are reset or closed out. So here we're only going to deal with the projected benefit obligation, the PBO, to start with, and it tells us we begin with a balance of $25 million in that account. Now that would be a credit balance. So if you want to make note that it's a credit, by all means you can. We know PBOs are liabilities, so a positive entry there would be a credit to that account. During the year one, pension benefits paid by the trustees were $5 million. Service costs for 1 year, or year one, was $10 million. Pension plan expense at fair value increased during the year by $4.8 million as expected. At the end of the year, there was no prior service cost and a negligible balance in the net loss AOC. The actuary's discount rate was 8%. So let's talk about the things that go into the actual PBO, projected benefit obligation here. When we look at it, there's really 5 things we have to take into account to find the PBO. First, you know the beginning balance, but the things that impact the PBO are the service cost, the interest cost, the prior service cost adjustments, the actual gains or losses on PBO, and then any paid benefits on that, because when we pay out a benefit, it reduces our obligation. Now, we defined each of those in the last video, but just a refresher. Remember the service cost, that's the increase in the PBO from employees completing 1 additional year of service for our company. In other words, for every year that you have a PBO here, your actual benefits will increase, because the way we actually calculate your benefits would be your benefit percentage, whatever that is set by the company, times the service years, times your final year salary. So the service cost simply means our service years go from 10 to, say, 11. That's the cost of doing 1 additional year of service. Interest cost. Well, a PBO is a liability, therefore liabilities accrue interest. So that's pretty self-explanatory. So we just take our PBO balance there at the beginning times our interest rate. And that's going to tell us sort of what our current interest would be on that debt. The prior service cost adjustments. This occurs when the pension formula is adjusted. And typically when it is adjusted, it is retroactive. Well, what does that mean? Well, again, our typical benefit calculation would be like benefit percentage times service years times final salary. Well, to change that, that means let's say our benefit percent started at 1.5, we change it to 1.7%. That extra 0.2% interest is retroactive, so it goes all the way back to the beginning of our service time. So when that happens, it creates a prior adjustment for prior years. Okay. Now keep in mind, if this exists, you do have to add this number here to our 25. Oops, wrong button there, sorry. So the prior service adjustment to the 25 to calculate your interest cost. The reason being is because it would be considered retroactive. When you make a change in that formula and you create prior adjustments here, that actually creates additional interest. So if that happens, you would take the 25 plus that extra prior service and then multiply it by the percent to get your interest cost for that year. Okay? So just keep that in mind. If there is prior service cost adjustment, that is considered retroactive. So therefore, to get your interest cost, you would take this plus your beginning balance times the rate. And that would tell you what your actual interest cost was. Now, next is the actuarial gain or loss. What is that? Well, that's due a change in the estimated service years or the final salary. So again, just keep that in mind. Let me go over here to the side and write this formula. So typically, what impacts these three numbers? Let's do it this way. Let's freeze our panes just so we'll have it. So let's scroll over here really quick. So typically, what we mean here is a typical formula would be our benefit percentage. So do you get 1.5%, do you get 1.7%, whatever. That's set by the company, times your service years. That's just however many years you work, so that's what you're granted. And then times your estimated final salary. So we project what your final salary will be when you actually depart the company at age 60 or 65 or whatever you can start drawing your pension is at that point in time. So for example, let's say our initial formula is 1.5% times our service years times our final salary. Now, what this PSC here would be, would notice how that changes. Let's say we make that 1.7% times our service years times our final salary. Notice it doesn't impact service years or final salary. It just simply makes a change in the percentage that we're going to pay out. When that happens, it's considered retroactive. So it gets restated. Prior years will then need to be brought up to that 1.7 when we were carrying them at the 1.2. Now, actuarial gains or losses, we're going to keep that 1.7% because that impacts our additional prior service cost here. But what that means is we change our estimated service years. So let's say prior year it was 12. Now we're going to say our future service years will be 13. So that one extra change, that creates an actuarial gain or loss because they're making a change in the service years that they did not anticipate in the last. So if you change the service years or if you change the estimated final salary of all your employees, either of those two changes creates what we call an actuarial gain or loss. Okay, they've made a basis change at that point, and that costs us money. Now, why is that important? Well, those gains or losses are then amortized over time. They're not immediately impacted because we're not going to notice that expense this year. It's actually going to get amortized over a certain period of time, a number of service years in the future to get that. Okay, so that's why it's important. And then the last thing is really self-explanatory benefits paid. That's whatever we paid out this year in benefits. All right, so now that we've reviewed really quickly what each of those components are, your PBO is comprised of those 5 items always. So when we're looking through there, just figure out what's the service cost, what's the interest cost, is there a prior service cost adjustment? If there is, take it into account before calculating your interest. Actual gain or loss, and then benefits paid. So we already got our beginning balance of 25. Let's take into account those 5 items. So let's start with, well, we can really start anywhere. Let's start with service costs because that's the first one on my list. Do we have service costs? You always have service costs because that's the cost of one additional year of service for our employees. In other words, this year our employees have worked 10. In future years it goes up to 11. That's what we've actually cost us because now they've worked that 11th year, whereas last year they only had 10 years of service time. Every year that our employees work, they get extra benefits. Their benefit amount will go up over that time period. So for our service cost this year was $10 million. So we're going to go in. That's actually expense to us. So we're going to go in and hit a $10 million increase in our PBO because it costs us more money each year that our employees work for us. In the future, when they retire, it'll cost us more money. Then we got to find our interest cost. But before we do that, let's see if there's any prior service cost adjustments. So let's see, did they make a change in the plan itself? It says the benefits paid were 5. The plan assets increased during the year 4.8 million as expected. At the end of the year, there was no prior service cost. Okay, so that tells us there's no prior service cost. So we do not have an adjustment there. So that's going to be 0. So to come up with our interest, then we can actually go in and calculate that now. We can take our total balance times our rate. So it tells us the actuary's discount rate was 8%. So go in and to find our interest cost, we're going to take the 25 times the 8%. So 25 million times 8%. So get out your calculators. You know, accounting, you can't do it without them. So 25 million times 8% is 2. Now, interest expense is an expense. It increases our obligation. So that would be an increase of credit. Now, actuarial gains or losses. Do we have any of those? Well, it doesn't say anything about an actual gain or loss this year. It does say that there's a negligible balance already from prior years, but it doesn't say that our actuary changed any service years or final salaries. So in that case, that would be 0 as well. Again, it would give us that number. If they did, we would put that in there. And then last is benefits paid, and it said that we paid out $5 million in benefits this year. So $5 million in benefits this year. Now, when we pay out benefits, does it increase our obligation or does it reduce our obligation? Well, it's going to reduce our obligation. So we're going to go in and take out 5. So that way we can come down here to the bottom and say, what's our total change? Well, we started with 25. Your service cost, your interest will always add to, so we add the 10 and the 12. So that brings us to 37, and then we're going to subtract the 5. So that brings our ending balance to 32 million. So that's the amount in PBO we would hit for this year. Well, the actual amount would be just the change. We already got the 25, so actually 7 million change. So if you want to do a journal entry here, that means we're going to hit this account for 7 million. So we can just sort of extend this total line here. If you so desire, you don't have to. But I'm going to right here so that we have it. Let me see, format. And we'll just put it across here. There we go. So I know that looks a little funny, but these 5 items will change it by 7. So we had 25. We're going to credit the PBO for 7, and that'll give us a total balance of 32. So when we're calculating the PBO, there's 5 things we have to take into account. The service cost, the interest cost. If there's a prior service cost adjustment, in other words, did our actuary change our benefit percentage? Is there any additional actuarial gain or loss? Did our actuary change the service years or the final salary? And then what was our benefits paid out of the plan? Now, when you do that, your actuary will give you this information. It's not something that accountants come up with. We just get the information from our actuaries. They're the ones who plan out our benefits. And once they've properly calculated that, they will send us the information. We just have to know how to calculate the final balance in our PBO. So those are the 5 things that always impact the PBO.